Kia ora everyone, I'm Mary Jo, Kiwi Bank economist. So it's pretty easy to get caught up in the recent run of good local data. Business confidence is improving, with more firms feeling upbeat about expanding their business and increasing headcount. Consumer spending remains elevated, and the strength in sales activity and house price growth continues to surprise us. But when we take a look at how inflation's tracking, we get a bit of a reality check. You see, the September quarter inflation print came in a little weaker than expected, with CPI rising to 0.7% in the quarter rather than a 1% rise that the market was expecting. Now, it's true that economic activity has rebounded since the June quarter collapse, but the big increases we are expecting in prices for things like food, housing, and transport simply weren't as big. Now, even if we strip away any issues with seasonality or COVID related data difficulties, the third quarter inflation print is still soft and is still a concern. You see, the September quarter is the first quarter since the lockdown was lifted, so we are expecting this inflation reading to be the strongest. What the unexpected weakness in the report suggests is a more sluggish start to our economic recovery. And that's not great news, especially given the fact that we're heading into the summer months, which is traditionally a time when international tourism is high. So it'll be particularly challenging for those businesses reliant on international tourists to continue to operate in the summer. Now, the growing spare capacity in the economy as unemployment continues to track higher will continue to drive prices and wage growth lower. In fact, the threat of deflation should certainly force policymakers to continue to do whatever they can to stimulate economic activity. From the Reserve Bank's perspective, they'll want to see rates even lower to incentivize borrowing and investment. The highly anticipated Funding for Lending program will most likely be announced in November, and we still expect a cut to the official cash rate early next year. Now, from the government's perspective, more targeted assistance, perhaps towards the tourism sector or towards reallocating workers into other sectors of the economy, could also be on the cards. That's it for this weekly wrap up. I'll talk to you in the next one.